Hi everyone, this is Jason Burek of Wall Street for Main Street. I just wanted to do a short video today talking about something I think is imminent, and that is the European banking crisis and the possible contagion spreading to the rest of the banks, and how the elites and the mainstream financial media and the mainstream media are really not telling you exactly what's going on. So we're going to go to Zero Hedge and show you all the different articles that have been released by Zero Hedge over the last 3 weeks or so to a month, and show you guys the different things going on with European banks and why I think things are getting a lot worse. Okay, so just recently this week, the Federal Reserve announced a stress test, and the American branches, U.S. bank subsidiaries of Deutsche Bank and Banco Santander, which is, I believe, a Spanish bank with branches and locations all over Latin America and South America, failed their probably very low bar stress tests. They said Morgan Stanley conditionally passed, but I think that's pretty much a joke. Zero Hedge also covered this story before the mainstream financial media did. This story actually showed up on Facebook, believe it or not. Facebook even covered it, which was surprising. I guess the financial media had to cover the Fed stress test. But as part of the story here, Facebook is saying, Zero Hedge is saying that 31 banks, and this is probably collusion here, have all initiated in the last couple weeks share buybacks and dividends. Okay, if there is a potential banking crisis coming, starting in Europe and spreading all over the world, why are the banks doing share buybacks and dividends? The answer is really simple. I think that's to slow down the hedge funds that have been shorting the banks and making big money doing so. So this is to buy time. This is to keep the bank executives' bonuses and things like that. So there's just an enormous amount. By the way, guys, I'm going to go through these Zero Hedge story headlines. Look at all the companies here, though, the banks that are doing buybacks and dividend increases. So this seems to be coordinated. Obviously they can borrow very, very cheaply. And so the bank executives are trying to fight the shorts, trying to squeeze the shorts out, get some of them to give up, to buy some time. But this is like putting a Band-Aid on a mortal wound. So this is not going to solve any problems long term with the banking system and fixing the bank balance sheets, etc. Just look at the Deutsche Bank stock price. So basically, for a year now, the Deutsche Bank stock price has been gradually going down. It almost collapsed. It's been basically collapsing. So it started at over $30, and now it's like around $13 a share. It basically here on the chart around 17, it had a full cliff dive there on very high volume. And I think Deutsche Bank, it may go to zero at some point, or it's going to be broken up and nationalized, and parts of it are going to be swallowed, and the German taxpayer is unfortunately going to foot the bill. The German taxpayer didn't do anything, didn't tell the Deutsche Bank employees to go make those stupid derivatives bets or anything like that, but the German taxpayer and probably other law-abiding, tax-paying European Union citizens are going to be devalued and on the hook for this. The XLF, here on the charts, this is a year-to-date chart. The XLF has had a lot of volatility on the bank. This is there's a number of bank index ETFs. These are something rather than picking out individual banks you can look at, but I want to show I think there's been manipulation here too. Look, we had a big cliff dive here, June 23rd, UK Independence Day, right? On very high volume. Look at the volume spike there, downselling, but look at the immediate up spike. I think that's manipulation on the up spike, guys, forcing it back higher from totally crashing. So there's just so much intervention in markets right now. Let me go through the Zero Hedge titles to show you guys the problems in different European countries with different European banks, that it's totally pervasive across Europe, all of Europe, and imminent. Okay. So, recent rise in delinquency rates. European banks have it. American banks have it in terms of loan delinquencies. We have diving into Deutsche Bank's balance sheet. I don't know how they would actually... Okay, they have a copy of the balance sheet here. But, obviously I'm not sure they're going to go into details on the derivatives. I'm going to attach links to all these articles so you guys can go more in depth. But this is going to be your short little primer for the European banking crisis that looks like it's going to start infecting all the other banks. Contagion, kind of like what we had in 2008 with the American banks and how they all made stupid derivatives bets and bets on subprime housing and mortgage-backed securities and things like that, and they were stuck holding the bag. How Bear Stearns and Lehman Brothers and Washington Mutual and Wachovia and those guys, those were the banks that had the problems. Obviously, there was the home builders and Fannie and Freddie and things like that too, but the banks were the ones packaging these pieces of crap up and selling them to other people, and they were packaging these things up so quickly they couldn't sell them fast enough. They also made synthetic ones too, which are fake ones. So they were just collecting the fees on these things. Okay, we got Italy. Italy just bailed out another failed bank, may use pension funds for future bank rescues. You know, if you think you're safe in America, this is probably going to come here too. I think eventually they're going to go after at least a portion of your 401ks and IRAs. They're either going to force you into U.S. Treasuries or something like that. There's bail-ins and bailouts coming forward, not just in Europe, but also, you know, the United States probably at some point as well. Italy granted extraordinary 150 billion euro bank bailout program to prevent panic run on deposits. Is Europe in trouble again? Hence some Portuguese, Italian bank bailouts suggest not all as well. You know, we know Deutsche Bank is one of the main problems. We've had that in the alternative media for a while now. And, you know, these guys weren't just making things up. A lot of the guys in the alternative media guys, they worked on Wall Street. So John Rubino, Dave Kranzler, a lot of these guys worked on Wall Street, and they were telling me, you know, private conversations and also in interviews that it was common knowledge for a very long time on Wall Street that Deutsche Bank had a derivatives problem, and, you know, they just kept sweeping these dog poops under the rug, and the rug just kept getting a bigger and bigger lump and just kept smelling, and, you know, people just pretended that, you know, the mess wasn't there. So we got Deutsche Bank poses the greatest risk to the global financial system. The IMF actually admitted this. 72.8 trillion in derivatives exposure. They're probably underestimating it. You know, we have over a quadrillion in derivatives. So, you know, Deutsche Bank to have that much in just one bank, that's really bad. You know, obviously, I think the mainstream financial media, while the stock market was rising in the U.S. since 2009, they would occasionally have some guys talk about bank balance sheets and derivatives. A lot of the bank experts that were on wouldn't even say that the banks were allowed to mark to model in their accounting. So, you know, a lot of them wouldn't even admit that. I spoke on Twitter with the fast money people, and a lot of them were edgy. Oh, bank stocks are value investing. They're good value here. Oh, they're a discount to their book value. Well, their book value is made up. It's not using real accounting. Okay, I mentioned this story again. I think this one's an important one here. This shows the strategy. They're using artificially cheap money from central banks to try and slow down the shorts. We had Kevin Duffy on at Bearing Asset Management. You can listen to his 2 interviews that I've done in the last couple weeks. He talks about how his hedge fund, Bearing Asset Management, him and Bill Wagner, they have a 20-year track record of shorting stocks really well. He talks about how they're heavily short European banks. Obviously, maybe in the short term, they're going to get pinched a little bit, but on this rise, they may even add to the short positions here. I think this is an interesting hedge play here. We may have bank nationalizations and things like that going forward with the banks, the European banks. They weren't recapitalized to the level the American banks were. Not that the American banks are really any better. They're using fake accounting. But at least there was an attempt to assuage people that, you know, the American banks got capital injections with TARP and all these other programs. That did not happen in Europe. But I still think the European Union taxpayer, the ones that are actually doing hard work and producing, they're going to get screwed the most. European savers too. So if you have European government bonds, you don't want to be in those. The European Union currency is going to be devalued. British pound's going to be devalued post-Brexit. These European banks that were in London, if the Brexit continues, even after the vote, then the banks are going to be moving probably headquarters to Ireland or some other low-tax country instead, where they can continue to try to do crazy derivatives trades and pay low taxes and things like that. Not that it's wrong to try and pay low taxes, but I mean, the banks get away with, you know, a lot of crazy stuff that's not legal. Okay, and the banks spent billions on stress test preparation. They spent billions of dollars, guys, trying to put lipstick on the pig. That's the old Wall Street saying, you know, putting lipstick on the pig. It's just unbelievable. We have zombie banks, a zombie financial system. The banks in Japan have been zombie banks probably longer than any group of banks. China is going to do some sort of bank bailout. Either they're going to raise the value of their gold reserves to a higher to re-liquefy their banking system, or devalue the RMB even more than they already have, or some combination of those things, because they have bad loans from municipalities and state-owned banks. So they're going to have to do some type of bank bailout as well. Japan, like I said, has been a mess for a couple decades now. Europe and the United States are also messes. So all of the major economies, guys, have problems with their banking system. This is due to central planning. A lot of the banks, guys, are basically government-sponsored enterprises, because they buy discounted government bonds, and return for that, in return for guaranteeing a market in these government bonds, the governments let the banks make crazy, stupid bets. There's a lot of experts out there in the mainstream that say Glass-Steagall would have fixed things. I really do not believe that. I really think the banks would have figured ways around this. People blame the housing bubble solely on Glass-Steagall. It's just not true. There was the Community Reinvestment Act long before that President Carter and other presidents kept adding to. There was an enormous amount of pressure for decades that politicians, especially Democratic politicians in very poor neighborhoods, forced bankers to give out loans, predatory loans, that for social justice and things like that the bankers knew. If you spoke to them, John Allison at BBT has covered this. He's the Cato Institute. He's wrote a book on this. You could go look it up. I forget the name of the book. I read it a couple years ago. There's other banking executives that you can talk to that say that they were forced to give out these loans to subprime. They knew they were going to be bad. I guess the banks figured they knew they were going to be bad. They may as well make some money on it, package up, and try and dump the risk on other people. So we have, student loan bubble, subprime auto loan bubble. There's just so many bad loans out there. The thing about Banco Santander that I wanted to mention that a lot of people aren't putting the pieces together is that with Banco Santander, they're a Spanish bank, but a lot of their loan growth has not necessarily been done in Spain. It's been done in South America and Latin America. It was to, businesses that were commodities exporters for oil, energy, coal, base metals, agriculture, things like this. The commodities have had a little bit of a rally lately. Not all the commodities, but agriculture and energy and precious metals, obviously. But a lot of the base metal ones are still screwed. There's going to be an enormous amount of copper and base metal miners going bankrupt. There was just so much artificial demand from China and central planning. Basically, the business model, guys, for a lot of South America, Brazil's the poster child for this, so is Venezuela, is they leverage their whole economies to China. So the politicians out there were able to borrow from European and American banks very, very cheaply for a while, leverage their economies to China, use debt to build out infrastructure and things like that. And, when the Chinese demand for these commodities slowed, because a lot of the demand was artificial from central planning, they didn't have a plan. A lot of these politicians probably figured they'd be out of office and have millions of dollars in their pocket already and all these connections to crony capitalists and get on board of directors and, be made like a figurehead title as management in a crony capitalist company and things like that. So I think the Banco Santander problems are showing us that South America, there's a lot of problems and bankruptcies and things like that coming in South America soon, because we're not going to see a huge rally, in my opinion, in steel, in iron ore, in copper, things like that. We may see a short little rally, dead cat bounce, because a lot of people are still heavily short these things. I was saying to short these things basically a couple years ago. It's a little early, but I think this is showing that with them actually releasing the banks now, that some of the names, the real problem posters. But the thing is, the banking system is so interconnected with derivatives counterparty risk that if Deutsche Bank or Banco Santander or a couple of these other banks fail, it could take the counterparties from other banks, other large banks that you think are more well capitalized, down with them. So I think we're an imminent European banking crisis, and I think it's going to spread going forward in the next 6 months. We might not even have 6 months. I would be absolutely shocked if they could delay this out. But we do know they are doing lots of liquidity programs behind the scenes to hide things. They can always change the rules with accounting and things like that. They may move the assets to bad banks, like what the U.S. did in the savings and loan crisis in 1980s. There was a lot of property bubbles in Dallas, Texas. Then Dallas wasn't affected by the 2008 housing crisis as much because they were familiar with the savings and loan scandal. They had their own property bubble decades prior. They may stick the assets in a bad bank to buy themselves time and just nationalize it, but that's devaluations with the taxpayer and stuff. So this is what I see. I see a European banking crisis imminent based on the Zero Hedge articles, talking with my contacts who are hedge fund managers who have researched the balance sheets and things like that. So for our European listeners out there, if you have a lot of money in European banks, maybe you should put a little bit of money in Bitcoin. Maybe you should open up a BitGold account. You should obviously have physical precious metals stored on your person, maybe even outside of Europe, in case they do rules changes or some type of tax or something, bail-in tax or something. So be prepared, guys. Look to protect yourself. If you're our European listener, I know we have a lot of them in England and all throughout Europe. Be very, very careful. Do not have all of your money in one European bank, and start moving your money into diversified bank accounts. If you can, maybe open up an American bank temporarily while you figure out how to diversify your assets even further out of European banks.